It's not going to take 7 years this time. It might be more like 7 months. And the reason is twofold. Number one, we're more leveraged and the stock market is more bubbly. And so the whole thing's more vulnerable. Number two, the market has seen this movie before. Like, hey, we watched this play out. We know it doesn't work. And the Fed balks. Now, so if the Fed suddenly slams on the brakes, says we're not going to keep raising rates along the lines I projected earlier, okay, that might give the stock market a boost. And you can't assume that won't happen. You got to watch for that. But I would expect that things would have to get pretty ugly in all events before the Fed got that message. On the other hand, if Powell gets confirmed and feels like it's his last term and here's his chance to be Paul Volcker and he's just going to keep raising rates, he said, my job is to get inflation under control. The rest of you people, you're responsible for fiscal policy and tax policy and spending and, shutting down the Keystone Pipeline.
Welfare.
And all that. That's on you, not me. My job is to get rid of inflation. If he does that, and he might, you're looking at a recession, kind of looks like the global financial crisis, and hope it doesn't. And there is a difference between extreme recession and financial crises. They're two different things, but they can happen at the same time as did happen in 2008.
In this video, Jim Rickards talks about the challenges and potential risks faced by the Federal Reserve in managing the economy. The central theme revolves around the delicate balance that the Fed must strike between preventing a stock market crash and avoiding a severe recession. Jim raises concerns about the Fed's ability to have perfect information, citing flawed models and the possibility of being behind the curve in recognizing economic challenges. The distinction between a recession and a financial crisis is highlighted, with historical examples used to illustrate that these two phenomena can occur independently. Jim Rickards emphasizes the difficulty the Fed might face in choosing between preventing a financial crisis or accepting a recession as a trade-off. The reference to Paul Volcker's actions in the 1980s adds historical context, showcasing a deliberate choice to induce a severe recession for the purpose of combating inflation. However, Jim Rickards notes that the current economic landscape is more intricate, with additional considerations such as systemic risks and the potential for a recession triggering a financial crisis. In conclusion, Jim Rickards underscores the complex decisions the Federal Reserve must make, acknowledging the uncertainties and trade-offs inherent in steering the economy and avoiding undesirable outcomes. Before we get into the video, can you help me to give that like button a little touch? Alright, let's get into it.
Would the Fed back off if it became apparent that they were going to cause a stock market crash, a disorderly collapse, and a severe recession? The answer is almost certainly yes, but the problem is it might happen anyway. In other words, they might have gone too far, and this almost happened in 2018, and that was my point. There was by the time they realized their mistake, it might already be too late. So that's one danger. If they had perfect information, oh gee, we went too far, gee, we couldn't pull this off, we need to back off. They might back off exactly as you described, but they don't have perfect information. They have flawed models. They tend not to look at history, and they could
behind the curve.
They could crash the car before they knew it was out of control. It's like slamming on the brakes on ice. You can slam on the brakes, but you're going to go for a long time before the car stops. So that's one problem. The second problem is you have to separate, as I said, recession, even severe recessions, from financial crises. In 1998, we had a financial crisis, but no recession. In 1994, we had a financial crisis, no recession. In 2020, we had a severe recession, no financial crisis. That was not a financial crisis. In 2001, we had the NASDAQ collapsed 80%, but there was only a very mild recession, and that was not a financial crisis. So the Fed might say, and again, might, because who knows, but they might say, well, of course we don't want a financial crisis. Now, to your point, Nick, nobody wants that, and they do get out of control. But we're not worried about that. We learned our lesson in 2008. We had Dodd-Frank. And I had this discussion with James Gorman, the CEO of Morgan Stanley. I briefed their board, and they gave me a lot of pushback. They said, "Well, you don't understand, Jim. We have more capital and greater liquidity and less leverage and better credit." And I granted. I said, "You're absolutely right." I said, "Nice job. You're a stronger bank now than you were then." But in a financial crisis, it doesn't matter. The problem is systemic. In other words, as an individual bank, you may be better off. But if the whole system's collapsing, you can't necessarily withstand that. So they don't want that. But what if they said to themselves, you know what, we don't want a financial crisis, but we don't think that's going to happen. But maybe we'll just have to bear a recession. Volcker knew what he was doing. Volcker knew that there was going to be a recession. And the recession of 1981-82 that he caused was, at the time, the worst since the Great Depression. Now, we've surpassed that twice since then, 2008 and 2020, although it's hard to know what 2020 was. I mean, down 36% in 2 months and up 38% in the next 2 months. I mean, what is that? But at least in technical terms, we've had two worse recessions, 2008 and 2020, since then. But at the time, and I lived through that, I was around, that was the worst recession. But Volcker knew that would happen. He said, that's the price we have to pay to break the back of inflation. And he did. And by 1986, inflation was like 2% or 1.8%. Now, there was far less worry about financial crises at the time. Because remember, this was before the repeal of Glass-Steagall. Commercial banks, no one really cared about investment banks. They could fail, so what? They cared about the commercial banks, and they had a pretty good handle on that. So they weren't worried about financial crisis. But today you would be for the reasons we mentioned. So there are two possible major blunders here, but again, don't underestimate the Fed's ability to do both. One is that they could decide they don't want a recession, but not know until it was too late. They just tighten into it, don't know it until it's too late, and then the damage is done. The other one is they could sign up for a recession, say, yeah, sorry, but that's the price of getting inflation under control, and trigger a financial crisis that nobody wants but could happen anyway. So, it's kind of so and Charybdis, take your pick. Severe recession, but we know it's coming. Recession that causes a financial crisis that we didn't want, or just let the inflation rip. What's the good outcome there? What's the good one?
Yeah.
But I think those are the three choices. I think you're right.
In the face of these complexities, our discussion leaves us with three potential scenarios: the risk of unwittingly tightening into a recession, the prospect of accepting a recession for inflation control, or the challenging choice of allowing inflation to run rampant. The Federal Reserve stands at a crossroads, and the decisions they make in the coming months may well shape the economic landscape for years to come. As we conclude our exploration, it becomes clear that the path ahead is fraught with challenges and decision-making. The balancing act between preventing a stock market crash and avoiding an unintentional recession places the Federal Reserve in a formidable position. The lessons from 2018 serve as a stark reminder that perfect information eludes them, and the consequences of their decisions may only become apparent once it's too late to correct. The historical perspective sheds light on the dual nature of economic downturns, where financial crises and recessions don't always go hand in hand. Drawing parallels to Paul Volcker's bold strategy in the 1980s, we ponder whether the Fed might consider accepting a recession as a necessary sacrifice for taming inflation.
Debt can be managed if you have enough growth, but we don't have enough growth anywhere in the world. The U.S. is growing the strongest, but only about 2%. Europe is growing around 1%, barely. Japan has actually been in and out of recession multiple times. China has a higher growth rate, but they actually manipulate a lot of their data. A lot of their growth is from investment, which is wasted. So if you discount for that, their growth is a lot lower. So the whole world has too much debt, not enough growth. That's the problem that the financial elites are trying to solve. Well, debt is not automatically a problem, subject to several conditions. If you borrow money and you put it to productive use so that the profit from the investment is more than enough to pay the interest, and if you're growing fast enough to afford the debt, then it's manageable. But that's not the situation in the world today. The problem in the world today is that a lot of debt is being incurred, the money's being wasted, and we don't have enough growth to pay off the debt. So this mountain of debt is getting larger and larger relative to the productive capacity of the economy. So again, if you can afford the debt and put it to good use, that's one thing, but that's not the world today. We're wasting the money and we cannot afford to pay it back. Well, once you're in the situation we described, there are only three ways out. One is growth, we talked about, but we don't have the growth. The other one is outright default, just don't pay it, which would cause a global financial catastrophe. We all know that. But as long as you can print the money, there's no reason to default. The third way out, and the one that the elites prefer, this is the global elite secret plan, is inflation. They have to have inflation. Basically make the currency worthless. So I can say, if I owe you $1 trillion, Simone, here's your $1 trillion. Good luck buying a loaf of bread because I printed the money and it's not worth very much. That's the secret plan. The question is, how do you do it? So we said that the elite plan is to have inflation. They have to have inflation. But the question is, how do you get inflation? I call this the problem of Jaggernomics in honor of Mick Jagger, member of the Rolling Stones band. They had a song, "You Can't Always Get What You Want." So the problem today is central banks want inflation, but they can't get it. But by money printing, forward guidance, other market manipulations, they have not been able to get the inflation they want. So now the global elites are saying, okay, monetary policy will not solve the problem. Monetary policy alone will not give us the inflation we want. So we have to try something else. And the question is, what is the something else? There are a number of plans. One of them is negative interest rates. And the idea is, so normally you put your money in the bank and you earn some interest. The bank pays you money. With negative interest rates, you put your money in the bank and they take your money away. Now this is designed to get you to spend it. The idea is, well, if Simone knows I'm going to take her money away, she'll go spend it rather than sit there and let it be taken away. But this is a typical financial elite plan. They don't understand real world behavior. They don't understand how people actually think. What people do is they say, well, if you're going to have a negative interest rate, you're going to take my money away, I have to save more in order to meet my goals, whether it's buy a house or pay for my children's education. So people actually end up saving more. They also say to themselves, what signal are the central banks sending with negative interest rates? They must be worried about deflation. Deflation means lower prices, so people say, well, I'm not going to spend it. I'll wait till prices drop and then buy something later at a cheaper price. So negative interest rates are designed to encourage spending, but they actually have the opposite effect. They encourage more savings and less spending. Very typical of these elite plans. They dream up these ideas, but they don't work in the real world. The second thing they're thinking about doing is called helicopter money. And this goes back to a speech that Milton Friedman gave decades ago. And he said, well, look, central banks can always cause inflation. All they have to do is print money, push it out of helicopters. People will run around, scoop it up, and take the money and spend it. But the question is, how do they actually do it? What do they mean by helicopter money? Well, what they mean is you're combining fiscal policy and monetary policy. So on the fiscal side, governments will spend the money. See, the problem is people don't want to spend. They're fearful. They want to save more, spend less, de-lever their balance sheets, not take as much risk. But government's very good at spending money. We would run larger deficits, have more government spending. Could be on whatever you want. It doesn't matter as long as you spend the money. It could be infrastructure, it could be defense, could be social welfare programs, benefits, medical, etc. Whatever it is. The government spends the money. This means larger deficits. How do you cover the deficits? Government borrowing. How do you issue the debt? The central banks print the money and buy the debt. So basically you have the government and the central bank working together to spend more money and then issue more debt and then print the money to buy the debt. So that's what helicopter money is. This is very likely to be inflationary. There are two other ways that the elites are trying to get inflation, if they have to. One would be through the IMF to issue SDRs, which are special drawing rights. I think in French it's DTS. It's a special drawing right from the IMF. This is money from thin air. This is world money, because the European Central Bank can print euros. The Federal Reserve can print dollars. Well, the IMF, the International Monetary Fund, they can print SDRs. They can print their own money, hand it out to their members, and then that money can be spent. So that's another way to do it. And then the fourth way to do it, and this is the last resort, not something they want to do, would be to arbitrarily raise the price of gold. So a central bank could come along and say, you know what, as of today, the price of gold is going to be 5,000 euros per ounce. Just declare that. And then you would say, if you think that price is too high, sell us your gold, we'll buy it, we'll print money and buy it. If you think it's too low, come and get it, we'll sell you the gold. And in Europe, Germany and France and Italy and the European Central Bank have a lot of gold. The United States has 8,000 tons of gold. Europe has over 10,000 tons of gold. So if you say, okay, so the price of gold is 5,000 euros, I'm a buyer at 49.95, I'm a seller at 50.50. So you make a market, I'll use actual government gold to back up the market, then gold is 5,000 euros per ounce. Now the point is, nothing happens in isolation. If you have 5,000 euro per ounce gold, it also means the price of oil, the price of copper, wheat, steel, cotton, everything else, wages would go up as well. So it would cause inflation. So you basically have four ways to get inflation: negative interest rates, helicopter money, SDRs, and raising the price of gold. They may go to all four. They may try them one at a time and end up with a higher price of gold. But here's the thing, Simone. All of them mean a higher price of gold. It doesn't matter how you get the inflation. Once the inflation comes, the price of gold is going to go up. That, just to kind of summarize and wrap up everything we've said, there's too much debt, not enough growth. The solution is inflation, but the question, the problem the world is facing, how do you get the inflation? And we've outlined the ways. The first is negative interest rates, which means a war on cash. Second is helicopter money. The third are the special drawing rights, just world money. And of course, the fourth way is to raise the price of gold. That will be the last resort, but those are the four ways. All of them are inflationary. All of them mean a higher price for gold. Well, that's right, Simone. We talked about this global elite plan for world inflation and how they're going to get there. We've gone through that in a lot of detail. But that's just part of an even bigger plan. What they want is world inflation, world money, world taxation, and a world central bank, which will be the IMF. So the IMF will be the central bank of the world issuing money. That'll make dollars and euros much less valuable because the SDR will be the new global currency at that point, of course, which is highly inflationary, which we talked about. And then finally, who controls the IMF, the central bank of the world? They have an executive committee, but it's really the G20. So I think of the G20, which are the largest developed economies and emerging markets such as Russia and China and Brazil and a few others. The G20 are the board of directors for world control. You know, Simone, it may be too late for small savers to stop this elite plan. They may not be able to do anything about it, but it's not too late for them to protect their own net worth. They can do that. My first recommendation is investing 10% of your investable assets in gold, physical gold. So not gold futures or gold options or other gold paper products, as we call them, but actual physical gold kept in non-bank storage in a safe place. Not 50%, not 100%. You should never go all in, but I recommend 10%. That's enough to preserve wealth if everything else falls apart. For the rest of your portfolio, there are a number of things you can do. I actually recommend some cash. You might not want cash for long, but temporarily it'll reduce volatility, and you can use the cash to buy more gold when the time comes. And then also some private investments and in growth areas, technology, natural resources, hard assets. So there is a model portfolio that we recommend, but it starts with 10% gold. Vladimir Putin has a 6,000-member cyber brigade. They work day and night to penetrate Western financial systems in Europe and the United States. They can completely wipe out your digital wealth. It would be gone and you would never know it.
But David, many stocks in the U.S. are down. There are a few stocks that are going through the roof every day. I mean, some parts of the U.S. market are developing a market, beginning of a bubble, but many parts of the market are not. That's why I would suspect this is going to go on for a while. Japanese market is down 30% from its all-time high, and the Bank of Japan buys ETFs. It prints huge amounts of money and buys ETFs every day. David, he has more money than I do. If he's going to buy ETFs, so am I, and the market's down. Likewise in China, the Chinese market is down 30 or 40% from its all-time high. You know, and they've done a less bad job of dealing with all of this. So China, Japan, Russia's hated. There are markets that are still down, and I would prefer to buy those. But, you know, they're also, I mean, commodities. Commodities may be the cheapest asset class around right now. We've had bear markets periodically for hundreds of years. We will have them again. In 2008, we had a bear market because of too much debt. Well, David, since 2008, debt everywhere in the world has skyrocketed, staggering amounts. So what I said was, the next time we have a bear market, and I don't know when it's going to be, watch Kitco News. They'll tell you when it's coming. But when it comes, it's going to be the worst in my lifetime. It has to be. Because the debt is I mean, maybe I'm wrong. And if I'm wrong, you tell me why. But the debt is so much, much, much higher all over the world now than in 2008. Well, when markets start going down, when bear markets start, for whatever reason, people are very skeptical of companies that have a lot of debt, because that's fear. As exuberance gives way to fear, people start worrying about will they survive or can they survive, or their earnings must go down because they have so much debt. And some companies start going bankrupt, really bad ones, and it spreads. I mean, this is just a simple bear market now. I'm not making any of this up. It's happened hundreds of times in bear markets all over the world throughout history, and that's the way they work. As I look around the world, bonds are a bubble. Many stocks are making all-time highs. Property in many countries is certainly in a bubble. The cheapest asset class I know are commodities now. I mean, sugar's down 80%. Silver's down 50% from its all-time high. These are this is not a bubble. As I look at asset classes, at the moment, commodities seem to be the cheapest. I'm buying more commodities as we speak.
You've launched an ETF, the Rogers Commodity Index Fund, back in the 90s. What were the components of this index, and how did you decide the percentage of allocation of components when you launched this ETF?
Well, I was about to go around the world, but I realized that the commodity bull market was about to start. I wanted to invest in an index because I was going to be traveling. I looked at all the indices. None of them were, I wouldn't invest in any of them. They were all hopeless. So I came up with my own. There were over 35 components. And it was basically, because I wanted it to be a worldwide index. Many of the indexes were pretty narrow that existed, and they were mainly U.S.-centric. I wanted something that would give international, the cost of doing business, the cost of staying alive. So there were over 35 components, and the weightings were essentially based on oil was much heavier than sugar, because we all use a lot more oil than we use sugar in our lives. Oil is in the process of making a complicated bottom. Bottoms go up and down, and go sideways for a while, and then eventually turn around and go up. We're beginning to see bottoms developing in energy because it takes a while, and because of the demand, which is down a lot, but we're making a bottom.
Right.
I have no idea of when it ends, 2021, 22, 23, but then it'll turn around and start going up again.
What about, let's talk about gold and silver now.
Gold is a commodity which has been around for centuries and will continue to be around for centuries, whether we like it or not. I'm an old peasant, and us old peasants know when things go wrong, we better have some gold. We better have some silver in our closet or under our bed, because it is the thing which will get us through when governments or currencies start having problems. Well, gold is near its all-time high. So gold is near its all-time high. I don't know what else I can tell you. It's not making lows. I'm not buying gold. Lots of people are being forced to sell their gold to buy food right now, especially in India, which is the largest gold country in the world. But I will be buying more gold, and I'll be buying more silver later. I'll buy more silver than gold because silver is much cheaper on a historic basis.
Analysts I've spoken to have said that even though it's reached all-time highs, this is just the beginning of a larger bull run into potentially even newer highs. Can you see that happening?
Yes, no, I suspect they're right this time, because there's going to be great turmoil.
Yeah.
Certainly in the next 2 or 3 years in the world market. We talked before about gigantic amounts of debt. We talked about how a bubble is starting to develop in some stock markets. The bubbles always end. When that ends, all this debt comes crashing in on all of us, many people are going to turn to gold and silver again.
How is it possible that we have stimulus on such a large scale today? Would this have been possible back in the 80s or 70s?
No, of course not. William McChesney Martin in the 60s wouldn't. Are you kidding me? No. He was the guy who came up and said, well, my job is to take the punch bowl away when people start having fun. When they're not having fun, I give them all the punch they want, and when they start having too much fun, I take the punch bowl home. Volcker was another guy like that. But since then, in the last 30 years, India had a good central banker for a while, but I cannot think of any decent central banker in the past 20 or 30 years other than them. Now, central bankers are essentially bureaucrats and politicians who really don't have a clue. Their job is to keep their job, and the way they keep their job is to keep people happy, and that means print money and spend money and borrow money.
Do you like the technology sector?
Do I like it? Well, I mean, I'm not going to buy those things. You kidding? I mean, Apple.
No.
I'm not just the first one to know about Apple. You know, apparently every new investor in the U.S. right now is buying Apple.
Yeah.
You know, in China, they're buying Tencent. They're buying all of these stocks, the new investors. It's not for me. I mean, it may double again, but not for me. I prefer to buy things that are cheap and hated.
So something that's not being looked at. So Apple, for example, is everybody analyzes that stock. There's as an investor, it's difficult to find value in something that's looked at by everybody. Is what you're saying?
Not only just looked at, owned by everybody.
Owned by everybody, yeah.
You know, and many who own it and don't even know what it is, but it doesn't matter. They're making money, so they're happy. But that's not for me. I mean, I bought a Russian shipping company recently. Oh my God, you talk about hated. It's hated. Russia's hated. That company's hated. There are opportunities where things are hated and nobody knows about yet.
The problem they're trying to solve is the following. We know from a long series of experiences, 30 or more business cycles since the end of World War II, that when the U.S. is in a recession, you have to cut interest rates 3 to 4% to get the U.S. out of a recession. You need 300 to 400 basis points of cuts to get the U.S. It's like a plane heading for the ground. How do you pull it out of a nosedive and get it back up in the sky? The answer is 300 basis points of cuts. How do you cut interest rates 300 basis points when you're only at 75 basis points? The answer is you can't. And forget about negative rates. The evidence is now pretty good that negative rates do not work. In other words, negative rates are not more of the same. When you go from, let's say, a half of 1%, then you go to a quarter, and then you go to 0, and then you keep going to negative 25, you didn't just ease by another 25 basis points. The evidence from Japan and Europe is that you're through the looking glass and you have very strange effects, really unintended consequences. I'll give you a couple examples. So the conventional theory is, well, the more I cut interest rates, the more stimulus I get. That's a joke, but that's what they think. But if I go negative, you're absolutely going to go out and spend the money. Because if you don't spend the money, I'm going to take it away. You sit there long enough, you'll have nothing left in your bank account because I'm going to take, with these negative interest rates, I'm going to take it away. So people will run out and spend. And the other thing is that, it's obviously, from the lending point of view, they'll borrow money, because the bank pays you to be a borrower. But here's what happens in the real world. This is the difference between academics and human beings. When people see negative interest rates, people have goals in mind. They have lifetime goals, right? They want kids' education, parents' health care, their own health care, retirement. If you start taking their money away with negative rates, guess what they do? They save more. They're like, hey, I got to put my kids through college. You're taking my money away. I better save more. And then what kind of signal is the central bank sending with negative interest rates? They're sending a deflationary signal. So people go, well, if you think it's going to be deflation, I'm not going to spend money. I'll wait till the price comes down. So you're trying to encourage lending and spending, and what you get is more savings and no spending, deferred spending. You get the exact opposite of what you want. So again, another egghead experiment gone awry. But the point being, so negative rates don't work. So zero bound really is zero. It really is a boundary. And Bernanke has said this in his recent writings, and I think he's right about that. So back to the problem. How do you cut interest rates 300 basis points when you're at 75? Well, the answer is you can't. So you have to raise them to 300 basis points. So the problem the Fed is trying to solve is how do they get rates to 3.25% before the next recession? Now, I'm not saying the Fed sees a recession, and that's easy because the Fed never sees a recession. In 102 years, the Fed has never seen a recession, never forecast a recession. But they know their economic history. We are 8 years into an expansion. It feels punk. I mean, the growth is anemic, but labor force participation is low, productivity is dropping. There are a lot of bad things going on, but in fact, we are in the 8th year, actually coming up on, soon be entering the 9th year of an expansion, which began in June 2009. Right. By the way, you have a hard time convincing most Americans that we're not still in a recession. Depressions are different than recessions. The technical definition of a recession is 2 consecutive quarters of declining GDP with rising unemployment, a couple other bells and whistles, little subjective factors, but that's basically it. So people, when you say depression, they're like, depression sounds worse than a recession. And if recession is 2 quarters of declining GDP, then a depression must be like 10 quarters of declining GDP because it's got to be worse. But that's not the definition. The definition of a depression, you can have growth in a depression, but it's below trend growth. In other words, if trend is 3.5, and you're actually banging out 1.5, 2, that gap between, let's say, 1.5 and 3.5% growth, that's depressed growth. It's an output gap. It compounds over time, and you never get it back. We are losing trillions of dollars of wealth. We are impoverishing future generations on a relative basis because of our inability to get back to trend growth. So the reason American people feel this and don't listen to the economists, and they're right, is because we're in a depression. So leaving that aside, the Fed at least understands the business cycle and the fact that the next recession, they say they don't die of old age, but they do die, and we're getting close to the next one. So they are in a desperate race to get rates up to 3.5% before the next recession hits so they can cut them to get out of the recession. The question is, can you raise rates enough to cure the next recession without causing the recession you're preparing to cure? That's the dilemma. That's the finesse. My answer is no, they're not going to be able to do it, but they think they can. Why are they in this box? Well, because Bernanke should have raised rates in 2010, 2011, in the early stages of the expansion, when the economy would have been much better able to bear it than it is now. Bernanke skipped the whole cycle. He skipped a whole rate increase cycle to pursue these wacky experiments and, QE and zero interest rate policy and all that. I spoke to Bernanke about this, and he used the word experiment. He said this was an experiment. Bernanke made his academic reputation by studying the Great Depression, in the wake of Friedman and Anna Schwartz and some others. But he was a great scholar of the Great Depression, and he got his chance to kind of try out his theories. But what he told me was, he said 30 years from now, some new Ben Bernanke, some young scholar, will look back and tell us if we did a good job or not. We actually don't know right now. See, the Great Depression was really two technical recessions, 29 to 33 and then 1937-38. But from 33 to 37, we had an expansion, but the whole thing was a depression because we never got out of it. The stock market recovered the 1929 high in 1954. It was a long time to get back to even. But Bernanke's mantra was, doing something is better than doing nothing. I completely disagree. It's better to do nothing if you don't know what you're doing. And this is really the monetary equivalent of the Hippocratic Oath. Doctors say, first rule of being a doctor is first do no harm. Anyway, bottom line is, by pursuing QE and zero interest rate policy, Bernanke failed to raise rates during the early stages of a cyclical expansion, which he should have done. If he had, the economy would have been just fine, and we'd be able to cut them today, but he didn't, so Janet Yellen now has to make up for lost time. So that's the mission, but again, and this is what the market completely does not get, and the Wall Street economists don't get. Nobody gets this, because they see the Fed raising rates, and they've done the correlations and the regressions back to World War II, and they go, every time the Fed raises rates, the economy is getting stronger. So if the Fed's raising rates, the economy must be getting stronger, so bid up stock prices, etc. But that's like saying umbrellas cause rain. Because they've got the causality backwards. The Fed never leads the economy, ever. The Fed follows the economy. So a normal business cycle looks like this. So you get a little expansion going, and unemployment starts to go down, and industrial capacity utilization starts to go up, and inflation starts to go up, and the Fed's watching, and then it keeps going, and they go, it's getting a little hot, we better raise rates, and they raise rates, but of course they started too late. The expansion keeps going, inflation keeps going up, unemployment keeps going down. Then the economy starts to cool down, unemployment goes up, and then prices go down, and capacity utilization drops, and we get into recession, we better cut. And then they cut, and then you hit the bottom, and then you come out of it again. So think of that as like a nice, pretty sine wave, right? That's a business expansion, business contraction over and over, 30 or so times since the end of World War II, with the Fed always following the economy, never leading the economy. So all the big brains on Wall Street, they've got all this data, and they say, well, every time the Fed raises rates, the economy is getting stronger. That has absolutely been true for 30 times since the end of World War II. It is not true today. The reason it's not true today is because Bernanke skipped the cycle, and they're playing catch-up. For the first time since 1937, the Fed is tightening into weakness. That's a key thing to bear in mind. The Fed is tightening into weakness. They are not leading the economy to strength. They are not responding to strength, even though Wall Street thinks they are. And there's a great danger that they're actually going to cause the recession they're preparing to cure, as I mentioned. The Fed will raise rates 25 basis points 4 times a year from now until the middle of 2019, until they get them to 3.25%. So like clockwork, every March, June, September, December, for 2017, 2018, into 2019, look for a Fed rate hike until they get to 3.25%, at which point they'll be able to say, all right, now we're 3.25. If we have a recession tomorrow, we can cut them back down to zero again and get out of it. That'll be mission accomplished. Now, this is why I was sitting there in December like, yep, they're going to raise them in March. And right now, I'll tell your listeners they're going to raise them in June. There's your Fed response function. There's your baseline scenario. What are the exceptions to Fed rate hike? And under what conditions will they not raise rates? Because everything I just described to you, they've had in mind since March 2015 when Yellen took patience out of the statement. That was the end of forward guidance. And by the way, if you go back to 2015, I said they're not going to raise rates all year, and they weren't going to do the liftoff that people were looking for in March, June, September, and they didn't lift off in September because the Chinese rate, the exchange devaluation, the stock market fell out of bed August 2015. Finally, they raised them in December 2015, and Wall Street was ready for March. I said no, in June, no, September, no. It wasn't until December 2016 that they raised them the second time. So obviously, there are conditions under which they don't raise rates, notwithstanding the baseline scenario. So what are those conditions? There are three. Well, four, actually. So if you see job creation below 75,000, that will cause them to pause. By the way, pause is the key word. If you go home through the speeches, you'll see the word pause in Dudley's recent remarks. Pause is the Fed's jargon for we're not going to raise rates. We got the Jim scenario, which I took from the Fed. It's their scenario. Or a technical recession. So, we're going to know Friday what the first quarter GDP is. It's pretty close to negative, but I'm not saying we're in a recession now. We might be. But if you see a recession, they'll pause. See job creation below 75,000, they'll pause. By the way, that's a very low bar. If you see a jobs report, see, this is the other thing that confuses Wall Street. You see a jobs report with 100,000 jobs, so Wall Street goes, oh, that report's really weak. The Fed's going to think twice. No, 75,000 is the number. Yellen told us that. It was in one of her speeches. You just have to be a geek like me and read all the speeches. So the third factor would be disinflation. So the Fed has this 2% inflation target. They've missed it for 6 years. They're finally getting close to hitting it. By the way, I think the listeners know they use the PCE core deflator year over year. There's PPI and CPI and core, a bunch of inflation indices, but we know what they use. PCE core deflator year over year. That actually has been getting close to 2%. But if you see it turn around, if you see that gap down to like 1.5, 1.4, 1.3, then they will pause. The last condition for the pause is a disorderly decline in stock markets more than 5%. If you see a 6, 7, 8% decline, so if the S&P went down 100 points, Fed doesn't care. Dow Jones goes down 1,000 points, Fed doesn't care. But beyond that, if you see the S&P start to go down 150 or the Dow start to go down 1,500 points in a disorderly way, it looks a little scary. It looks like there's no bottom. It looks like if you see that, they'll pause. So the Fed's going to raise like clockwork 4 times a year for the next 2.5 years, unless you see job creation below 75,000, disinflation, a technical recession. If you don't see one of those things, they're going to raise rates. And so right now, I don't see any of them. I mean, they could all happen, but it looks like, growth is going to be positive. Job creation's been decent, over 100,000. Disinflation is probably coming, but not quite here yet, and they'll want to see a couple months in a row. And the stock market's not crashing. So none of the pause conditions are in place. Therefore, they will raise rates. Simple. But the bigger question is, why on earth is the Fed raising rates when the U.S. economy is on the brink of recession? When the U.S. economy is hanging by a thread, you don't raise rates in a weak environment. You raise rates when, the economy's hot, unemployment's lower than it is, but inflation is taking off, things look speculative, and then you raise rates to cool it down a little bit, and then when the market cools down, unemployment goes up, inflation falls, then you ease, then you cut rates. And the Fed never leads the markets. The Fed always follows the markets. The Fed's always working with a lag. So why on earth are they raising rates in a difficult, challenging economic environment? And the answer is they're doing it for the wrong reasons. They are desperately trying to raise rates so they can cut them in the next recession. Yeah. The history is that you need to cut rates 300 or 400 basis points, 3 or 4%, in other words, to get the U.S. out of a recession. And typically the way it works is you go into a recession at, 6.5% interest rates. You cut them 3% down to 3.5%, maybe a little more. And then that's enough to get the economy out of the recession. Well, how do you cut 300 basis points when you're only at 25 basis points? Well, you can't, obviously. They're trying to raise rates so they can cut them. I say this is like hitting yourself in the head with a hammer because it feels good when you stop. But the Fed's conundrum is, how do you raise rates enough so that you can cut them in the next recession without causing the recession you're trying to prevent? That's the conundrum, and I think the answer is you can't do it. They're going to cause the recession. The Fed is not neutral when it comes to raising rates. They are biased in favor of raising rates. So it's not the case. When they wake up in the morning, they're not asking themselves, do I want to raise rates? Do I not want to raise rates? What's the data dependent, all this stuff. They wake up and say, I want to raise rates. Can I? In other words, just because they want to raise rates doesn't mean the coast is clear. So I analogize this to a little kid who's trying to steal money from mom's wallet. If mom's looking, they won't take it, but if mom's out in the backyard, they'll go grab some money. So the Fed will raise rates whenever they think they can get away with it. So they want to raise rates. They can't always raise rates if they think things are iffy or the markets don't expect it or financial conditions are already too tight for other reasons. They won't do it. But if the coast is clear, they will. When you throw out a phrase like world taxation, we talked a little bit earlier about world money, the SDR, and the initial reaction on the part of some readers is to roll their eyes and go, well, there goes Jim again with all his crazy conspiracy theories. But these are not conspiracy theories. Again, I make the point. This is very, very important. This is all documented. This is all happening. You can go to these websites. You can attend these meetings. You can look at these working papers. It's all real. Now, as far as world taxation are concerned, we said earlier they love these crazy acronyms that no one understands unless you're expert on all this. But the key phrase here is BEPS, B-E-P-S. That stands for base erosion and profit shifting. So base erosion and profit shifting are the bad things that corporations do to get out of paying taxes. And the governments are going to lead an attack on BEPS, attack on base erosion and profit shifting. And this is all being directed by the G20. And, of course, the G20 is this world leadership. It's basically the board of directors of the world. That's the easiest way to describe it. The G20 operates like a board of directors, but they don't have a big staff and directorate. But what they do is they farm out these projects to different existing agencies. It could be the United Nations. It could be the IMF. But we have another group called the OECD, Organization of Economic Cooperation and Development, based in Paris. This is a kind of a rich country's think tank, and the G20 have given the OECD the task of coordinating and implementing BEPS, the BEPS project. And the way it works is, let's say you have an invention, but you invent it in the United States. Well, if you patent that invention and license it for royalties, and all those royalties come to the United States, you're going to pay U.S. tax on it. But what if you take the invention and contribute the intellectual property to an offshore company, and then that company then does all the global licensing? And now all the licensing fees go into Dublin instead of Seattle, and you're not paying any tax there because you got a special deal with the Irish government. Well, that's the kind of thing that's going on. Many, many more complicated examples than that, but that's a simple one that makes the point. The other thing that's done is you mess around with debt equity ratios. So I've got an offshore subsidiary, and instead of giving a capital, I borrow a gazillion dollars from it and pay them interest. Well, what's happening with the interest? Well, it's a deduction in the U.S., and it's income in, say the Bahamas, right? So I get a nice fat tax deduction in the U.S. The money goes to a tax-free jurisdiction like the Bahamas, but I'm just taking it out of one pocket, putting it in the other, right? Because I own both companies, and the corporations are moving this money around so fast that nobody can keep track. So what the governments have decided to do is join forces, and they're going to create this global tax network. And they're going to say to every major corporation, you're going to have a global tax ID, not just your Social Security number, the corporate equivalent. You're going to have a global tax ID, and all of your subsidiaries are going to have IDs, and all of your transactions are going to have IDs. And all this information is going to be reported to a database to whatever country has jurisdiction. But then all the countries are going to share all the data using this unified ID system and then put it into one giant supercomputer and that everybody can access. So now all of a sudden, Germany's going to be able to see the other side of the trade. They may know that a German corporation is paying interest, but they'll be able to learn that the interest is going to an affiliate in Hong Kong that's not paying any taxes, etc. So they're going to have the complete picture. And then once you have the picture, you can attack it. You can use anti-avoidance provisions. You can use special laws and Section 269 of the Internal Revenue Code. I mean, they're equivalents all over the world. They have the tools, but what they don't have is the information. under this BEPS project, they're going to get the information. And then they're going to combine the information and the tools, and then they're going to tax these corporations, and they'll be able to run, but they won't be able to hide. And then they're going to raise the rates. And then a lot of people say, well, what's wrong with that? Why shouldn't they pay their fair share? And my answer is, you should pay your fair share, but what's fair? So this is a full-scale assault on the ability of corporations to legally avoid taxes, but it's going to segue into something that's much more punitive, much more extractive. But when you look at interest rates, you have to distinguish between nominal rates and real rates. Now, I'll give you an example. In 1980, I got my first mortgage on a condo in New York, and I paid 13%. And my mother cried. I mean, her first mortgage was like 3%. And here I am paying 13% on mortgage. My mother was all upset. She thought that was like a dumb decision. But I said, Mom, I'm paying 13% interest, but inflation is 15%, and taxes are 50%. So my after-tax cost of funding is 7, inflation is 15, my real interest rate is -8. The bank is paying me to borrow because I get to pay them back in cheaper dollars. Whereas today, even with, say, a 4% mortgage, if inflation is only 1.5, which it is, that's a positive real rate of 2.5. So when I borrowed at 13%, the real rate was -5. Today, when you borrow at 4.5%, the real rate is +2 or 2.5. So nominal rates are at an all-time low, but real rates are very high. And that's what drives economic decision-making, and that's what drives the economy. And one of the problems that economists and policymakers are wrestling with is, how do you get real rates negative? Because that's what stimulates borrowing. If I think I can go borrow money and pay it back in cheaper dollars so that the real cost is negative, I actually get free money from the bank, or the bank pays me to borrow. That's what a negative interest rate means. That's supposed to be a prod or a stimulus to more investment, more R&D, and more consumption, and more economic activity, and higher aggregate demand. But the Fed has a hidden asset.
In a surprising revelation, Jim Rickards talks about the Federal Reserve's balance sheet. He unveiled a hidden asset, gold certificates dating back to 1934. These certificates were issued to compensate the Fed when the U.S. Treasury confiscated its gold, a move that is believed to have legal complexities under the Fifth Amendment of the U.S. Constitution. The certificates, valued at the fixed rate of $42.22 per ounce on the Fed's balance sheet, were originally meant to represent the historical cost of the confiscated gold. However, the intriguing twist emerges when considering the potential revaluation of these gold certificates to reflect the current market price of gold, which hovers around $1,850 per ounce. If the certificates were marked to market, it could reveal a hidden asset on the Fed's books worth approximately $350 billion. This unexpected revelation adds an interesting dimension to the ongoing debates about the Fed's solvency and financial stability. The implications of such a revaluation extend beyond the immediate financial adjustments. It could revive discussions about the gold standard, a monetary system where a country's currency is directly tied to a specific quantity of gold. This potential move could be seen as acknowledging the true value of gold and its role in backing the country's currency. Jim Rickards speculates on how the gold price might react to such a revaluation, positing it as a significant event that could attract attention and prompt a surge in interest and investment in gold. Furthermore, the potential move could be perceived as the Fed indirectly reverting to a gold standard, with Jim Rickards estimating that a conservative 40% backing of M1 money supply would necessitate a gold price of around $15,000 per ounce. In essence, the idea of marking the gold certificates to market on the Fed's balance sheet is presented as a complex and potentially transformative event that could have far-reaching consequences, sparking debates about the role of gold in the modern monetary system and the potential impact on the economy.
If you go to the balance sheet, go to the asset side, the first line item, there's something called gold certificate. And what is that? Well, in 1934, the U.S. Treasury confiscated the Fed's gold. They'd already taken the gold from the U.S. citizens by that point, but they wanted it all. And so they took the Fed's gold, but under the again, bearing in mind the Fed's privately owned, so under the Fifth Amendment of the U.S. Constitution, it is illegal, it's unconstitutional to seize property without paying just compensation. You can do it, but you got to pay the person, and then people get into all kinds of arguments about what it's actually worth. So, what just compensation did the Treasury give to the Fed when they took the Fed's gold in 1934? The answer is they gave them a gold certificate. It can be, you can calculate it. In other words, you can say, well, what is the amount of gold by weight, not by dollar value, but by weight, that is needed to back up that certificate given the historic cost? So the answer is about 8,000 tons. Guess how much gold the Treasury has? About 8,000 tons. I mean, one of the reasons I've hypothesized that the Treasury stopped selling gold in 1980 because they lost gold to trading partners between 1950 and 1970. They lost 11,000 tons. They went from 20 to 9, but they sold another 1,000 tons in the 1970s to suppress the price of gold, which failed because it always does. But by 1980, they had were down to 8,000 tons, and they stopped. Why did the U.S. stop selling gold? We've never sold any significant amount of gold since. The answer is, in my view, is that they can't go below that because that's the amount of gold the Treasury needs to back up this gold certificate on the Fed's books. So, okay, just kind of put that to one side. That asset is valued on the Fed's balance sheet at $42.22 an ounce. The price of gold, look today, it was about $1,850 an ounce. Now, so, what's, as I say, sauce for the goose is sauce for the gander. If we're going to mark the mortgages to market in a world where interest rates have gone up and the mortgages have gone down, it's only fair to mark the gold to market. And if you mark that gold to market at $1,850 an ounce versus $42, voila, you would find that the Fed has another approximately $350 billion of hidden assets. So that takes care of the solvency problem. So before we beat up the Fed on mark-to-market on mortgages, that's fine, but have a look at the gold and realize that they have a hidden asset, a shadow asset on their books that's worth in hundreds of billions of dollars.
What do you think it would do to the gold price if they did revalue, mark-to-market their gold holdings? Do you think that would create a lot of attention for gold and people would pile in, or do you think it would just be an accounting change that no one really noticed?
I think it would be a very big deal. But it begs the question, if you're going to revalue it, to what level do you revalue it? So everyone said, well, the market's 1850, and that's about where it is today. It goes up and down, but revalue it at 1850. That could be highly deflationary. And the reason is, in effect, you're putting yourself on a gold standard. You don't have to. That's why they won't do it. They don't want to touch it. But if you did, you would be saying, hey, gold's really worth 1850 and we have this much gold, etc. But at that point, analysts would sort of turn and say, well, you're back to a kind of gold standard. What's the relationship between gold and money, or currency, or U.S. dollars and others, the money supply? But what is the relationship between gold and money supply? What you would find is that at 1850, the gold relative to the money supply is about 2%, whereas historic gold standards were run with somewhere between 20 and 40%. Bank of England in the 19th century managed a successful gold standard between the Congress of Vienna and World War I with about 20% gold. In the U.S., through most of the 20th century, at least the first half, ran a gold standard with about 40% backing. It was actually the law. The law until the late 1960s, I think 1968, was that the Fed money supply, base money, could not be more than 2.5 times the value of gold. Originally at $20 an ounce, $20.67 an ounce, later $35 an ounce. But whatever that number was, times the amount of gold, that had to be 40% of the money supply, and the money supply could not be greater than that. And then they got rid of that in 1968 because of the war in Vietnam. But the point being, 20% has worked. 40% definitely works. The Austrians like to bang the table and insist on 100%, but maybe. But that's historically not been required. You just need enough gold to be able to give gold to people who want it when they want it, and if you're credible in that dimension, most people are content to hold the money. So as a hypothetical, you can say, well, okay, let's say we want a gold standard, and let's say that we want 40% backing of M1. M2 is a bigger number, at least it can be. Let's just say, so 40% backing of M1, that's a conservative kind of gold standard, not extreme, but reasonable. what would given the amount of gold the United States has, what would the price of gold have to be in order to maintain that ratio? The answer is about $15,000 an ounce. And people say, well, Jim, you used to say $10,000 an ounce. Well, that's true because it was true at the time. But when you expand the money supply, the number goes up, right? Because the amount of gold is fixed. So yeah, it was 10,000 not that many years ago, and today it's 15,000. Well, if you say gold's worth 1,800, people are going to say, well, give me the gold. I'll take all the gold you got at that price. And then we're going to have to shut the gold window again, and that has its own problems. But in other words, it's not clear how it would work. I mean, there are a lot of ways it could work mechanically. It's not clear what the government would actually do. But my point is, if you try to mark gold to market on the Fed's balance sheet, you're opening Pandora's box. Because you would be getting a lot of people, bankers, analysts, Wall Streeters, investors, to sit up and take notice and say, well, hey, what is going on here? You're back in the gold business. Well, you got the price wrong because you can't back up your money supply at that level. And the truth is you can't.
Bima, apain HP-nya nih Bima? Ini kenapa bisa loading terus dia m-bankingnya? Kok nggak tahu Mima apain tadi malam ini? Nanti Mima apa nggak upgrade iOS gak?